Hello and welcome to our ATEL Winter Conference, the last one this year. Today we have a very interesting and diversified program. I hope you will enjoy it. I would like to thank our sponsors Scope, Redbridge, Arvato BFS, iUp and Delega. The first presentation will be led by Scope. Marc Lefebvre, Executive Director, Head of Business Development, France, Belgium and Luxembourg, will talk about the credit rating environment, how it evolved and why having a European agency is important. Marc, the floor is yours.
With pleasure. Scope is a challenger in the world of credit rating agencies. We are a European upstart facing tough competition from the US incumbents. If we look at the industry's history, it becomes easier to understand why investors and issuers need a new rating agency like ours, particularly in Europe. Investors have wanted reliable, independent assessments of investment securities to reduce the risk of losing their money ever since the birth of modern capital markets in the 19th century, if not before. It was increasingly badly needed in the wild days of frontier capitalism in the US. This is in essence the history of the expansion of the railways from the east to west coast, la conquête de l'Ouest, which opened up to the whole country to economic development. Some smart entrepreneurs realized that providing reliable financial data and credit opinions to go with them was a good way to help protect investors. Business owners began to realize too that it was a lot easier to raise money if a respected third party made it known that their credit was good. Merchant debts were the first to be rated, but the industry came into its own with the vast amounts of money borrowed to fund the railways in the late 800s and early 900s. The names of some of those entrepreneurs who provided the first data and ratings on railway and other corporate debt are the ones we still associate with credit ratings today, Messieurs Poor, Moody and Fitch. To understand today's credit rating industry, we need to fast forward several decades. The liberalization and globalization of capital markets from the early 1970s explained both the huge growth and the concentration of power in the modern credit rating industry. That concentration is quite dramatic. The oligopoly of US agencies led by Standard & Poor's, Moody's and Fitch has roughly 90% of the market. The three agencies rate trillions of dollars worth of debt issued every year. Warren Buffett, an investor in Moody's, has described the company as part of the natural duopoly with incredible pricing power. We can see why Moody's had an operating profit margin around 50% in the year to end December 2020. Of course, the established US agencies were well placed to take advantage of the exponential growth of bond market volumes and growing variety of credit products as financial markets were liberalized around the world in the 70s and 80s. But it is also the case that the barriers to entry for new players is very high in our industry. One barrier is regulation. Regulators are naturally hesitant to let just any company start credit rating to avoid the risk of poor quality rating starting market panics. This has the paradoxical effect of protecting the incumbents apart from the big three. Only 6 other firms are nationally recognized statistical rating organizations, NRSROs, in the US, even after all the criticism S&P, Moody's and Fitch received for their part in the subprime crisis in 2007-2008, these other firms have a very small share of the market. Secondly, big pension funds and asset managers have long-standing investment policies which preclude them from investing in securities which aren't rated by the incumbent agencies. Thirdly, the US agencies have had such a long head start over new arrivals that they have become part of the plumbing of financial markets, embedded in bond markets, contracts, settlement systems, data distribution sites, making them even harder to dislodge. The Scope Group was founded in Berlin in 2002 by Florian Schoeller, Scope Group's chief executive, as a firm specializing in the analysis of alternative investments. Like many, Florian was profoundly affected by the global financial crisis, particularly its effect on Europe in 2007 and 2008. So in 2011, Scope's shareholders and management decided that the firm would expand into rating credit with the goal of creating the European alternative to the US rating agencies. To build a platform for developing the new business, Scope acquired PSR Ratings, an ESMA-registered company specialized in analyzing companies in the automotive sector. Our next step was to grow internationally across relevant rating classes while building our reputation for the highest quality credit assessment. We hired several experienced and established analysts and managers between 2013 and 2015 to ensure that we had the industry-leading standards of quality and professionalism. Acquisitions have continued. In fact, we are the leading European consolidator of the region's fragmented rating sector, which is made up of lots of small specialist agencies. In mid-2016, we acquired Ferry Euro Rating Services AG. In January 2021, we acquired ELERMS Rating. Today, Scope Ratings, a wholly owned Scope subsidiary, is the market leader among European rating agencies. Scope's three main operating units, including Fund Specialist, Scope Analysis, and Scope ESG, offer a full suite of financial and non-financial ratings and services. We cover all asset classes: sovereign credits, corporate, financial institutions, structured finance, project finance, and ESG. Institutional investors have access to all rating agencies on Scope 1, our innovative digital platform. Today, we are a pan-European business. We have around 250 people in Berlin, Frankfurt, Hamburg, London, Milan, Madrid, Oslo, and Paris, our biggest hub outside Germany. None of this would have been possible without considerable investment. Scope has raised financing from investors across Europe over the past 5 years. Scope's shareholders have invested around 80 million euros, including from institutional investors from 4 countries in 2017 and 2018. Reichsstiftung, one of Germany's largest foundations, was in the latest institutional investors to show its confidence in our growth and becoming a shareholder in 2019. At Scope, we believe passionately that this is exactly what Europe needs. But it is not just us. Europe's policymakers have long recognized the region's need for its own strong independent financial institutions for several reasons. First, the global financial crisis of 2008-2009 and the European sovereign debt crisis of 2011 exposed Europe's vulnerability in the realm of credit ratings with issuers. Governments, banks, corporates, and investors reliant on credit opinions of the oligopoly of North American credit rating agencies, often poorly adapted to the realities on the ground in Europe. Secondly, there is the steady push by the EU to develop Europe's capital markets to narrow the gap in their depth and breadth compared with the US. The Capital Market Union, whose goal is to create a strong and unified EU capital market, is of significant strategic importance for Europe's economy. Thirdly, the economic shock of the pandemic has shown how indispensable it is for citizens of Europe to have strong, independent institutions with a stable European identity. This applies both politically and economically levels, not least in the increasingly integrated financial sector. In this context, we offer investors and issuers a European perspective on both credit and ESG. Our rating approaches and methodologies are based on a deep understanding of European realities. Let me give you 2 different sorts of examples. Scope is the first European credit rating agency to issue supranational ratings. Essential to our approach is the recognition that supranational institutions are not commercial entities, whether they are international bodies owned and controlled by governments that provide them with financial resources, credibility, regulatory frameworks, and the liquid capital markets to raise funds to support government policies. Our supranational ratings in Europe include the EU itself in addition to the EIB based in Luxembourg, the European Stability Mechanism, and the European Financial Stability Facility. Perhaps of more interest to those whose day-to-day focus is corporate finance, our corporate rating methodology includes a distinctive mix of quantitative and qualitative analysis. In other words, we rely on a thorough understanding of a company's underlying drivers of business and financial risk, while leaving room for the opinions of the analyst, the local and regional context, and common sense. Our approach to assessing liquidity management also displays our European perspective, setting us apart from the US agencies. We recognize that European companies are typically willing to hold large cash balances to guard against risk. Similarly, we believe pension liabilities justify different debt treatment in some conditions, as they have very different repayment schedules to loans and bonds. Another distinction of our European approach is recognizing the importance of the credit impact of the diversity of ownership structures, including the predominance of family-owned companies, even among Europe's biggest and most successful firms, such as those in the leading indices such as CAC 40, BEL 20, DAX 30. We took a big step forward in this regard in 2020 by creating the Scope Foundation, whose raison d'être is to protect and promote Scope's independence and Europe identity. Florian Schoeller and anchor shareholder Stefan Quandt transferred 20% of the share capital of the holding company Scope Management SA to the Scope Foundation to fulfill its purpose. Scope Management SA performs corporate management functions for Scope Group. I can't put the importance of this any better than Jean-Claude Trichet, a member of Scope's Foundation Honorary Board. Trichet said at the time that Europe, more than ever, needs a strong and independent European rating agency. The Scope Foundation is making an important contribution to ensuring that the company's European identity endures. The Foundation will ensure that Scope's existing anchor shareholders retain the appropriate influence over Scope's management and strategy. The Foundation will also ensure that Scope remains in the hands of European anchor shareholders in the long term. The leading figures from business and finance who make up the Foundation's Board of Trustees and Honorary Board will offer their expertise and counsel to the Scope Group. Backed by the Foundation, we feel Scope has a key role to play in safeguarding and promoting Europe's economic and financial independence, enhancing Europe's economic sovereignty. To that end, we will have done the preparatory work for Scope ratings to apply for Eurosystem Credit Assessment Framework (ECAF) status with the European Central Bank in 2022. We will be the only European credit rating agency to do so, as well as NRSRO status in the US for the benefit of US investors investing in Europe. Well, one measure of the difference we are making is that a growing number of leading international groups are showing their confidence in the European perspective that Scope offers in their ratings, including Barclays, Daimler, Lufthansa, Fnac Darty, Merck, Sanofi, Santander, Terna, Unicredit, Vonovia. Altogether, we rate more than 200 non-financial corporates across Europe. Another is that the Capital Market Union is slowly but surely helping transform the European economy. The CMU addresses the fragmentation of European financial markets by creating capital market alternatives for European companies which are still heavily reliant on bank loans for funding. Deeper, more liquid credit markets would particularly benefit SMEs and backers' infrastructure projects, particularly as Europe plans to invest heavily in ensuring sustainability post-pandemic growth. The COVID-19 crisis and the EU multi-billion euro recovery program make this more urgent, especially as policymakers, issuers and investors are paying more attention to sustainable growth. We have a crucial role to display in this financial ecosystem as a vital link between investors and issuers. Let me give you 3 practical examples of what this means. One of our fastest growing franchise is rating securitization, notably packages of non-performing loans sold to investors by banks in the euro area as they seek to bolster their balance sheets and increase their capacity to finance economic growth in the region. We are also the only credit rating agency selected to evaluate and rate ex ante the French Recovery Participatory Loan Fund, Fonds Préparticipatif Relance. The massive 11 billion euro program has been co-created by the French Ministry of Finance, Economy's Recovery, FFA, and major French banks to finance and enhance France's economic recovery through a dedicated SME fund, 30% guaranteed by the French state. Being at the core of the ecosystem in the middle of the equation between issuers and investors is our DNA. In terms of non-financial rating, Scope's ESG is offering, as an illustration, a second-party opinion service for green bonds and label ESG bonds having received the appropriate approvals of both ICMA and CBI. Scope has a unique value proposition in this field since it is positioned on ESG impact and the supply chain analysis. In the weeks and months ahead, we are sure to have more news for you which shows how Scope's role in facilitating the financing of the real economy in Europe is growing and how we are further enhancing our pan-European credentials. Watch this space!
Thanks a lot, Mark, for this comprehensive overview of credit rating landscape in Europe. Now let's move to the next topic. I will introduce Iris Rousselier, Head of Treasury Transformation, and Alexandre Lhéritier, Managing Director, Regional Head of Coverage of RedBridge. They will talk about an interesting topic. How can you avoid any impact of negative interest rate by enhancing the supply chain finance? I will let you discover their presentation and business case. Iris, Alexandre, the floor is yours.
Good afternoon, my name is Iris Rousselier, Global Head of Transformation at RedBridge, and I'm glad to be with you today.
Hi everyone, my name is Alex Lhéritier, Regional Head of Coverage at RedBridge, and I am delighted to be with you today to talk about how you can optimize your returns on corporate liquidity. The past few years have recorded a material fall in the spreads offered on cash investment. Today, most capital guaranteed euro investments offer negative yields. The good news is that some alternatives exist to help you boost your yields by up to 12%, starting with investing in your own supply chain. How does it work and what returns to expect? This is what we're about to share with you today. Let's start with the State of the Union. Most corporates will generally resort to 3 main options when it comes to investing their liquidity: bank deposits, money market funds, and market solutions. All of those are available overnight or within 3 months tenors in order to keep their cash equivalent status. Unfortunately, all 3 of them have been impacted by, first, bank regulation, Basel III, requiring banks to only allocate short-term deposits to short-term loans. Second, central banks' negative rates, or at least close to zero rates, such as the ECB or the Fed. And inflation, Indeed, factoring the latter, every G10 currency is now offering negative yields. It is worth adding that riskier alternatives do exist and can still offer positive returns, such as bonds, equities, or cryptos. But those remain most of the time unused due to their risky and high volatility natures. Last but not least, cash poolings are more and more becoming an issue as most banks are not charging the very excess cash they are helping you to centralize.
So now that we have set the landscape, what are the alternatives that our clients, whether they are cash rich or poor, are choosing to follow in order to increase the return of their liquidity? One main concept, the supply chain. So the main distinction between our client in a positive or negative working capital situation is the early payment supplier financing option. Indeed, cash-rich clients are capable of unlocking additional EBITDA by burning excess liquidity, while negative working capital clients are favoring liquidity over EBITDA in resorting to receivable financing, supply chain funding, or securitization program. They want to reach cheap liquidity. It is worth noting, nevertheless, that such option can offer off-balance sheet treatment, which can be really valuable too. So recent market trends have, however, highlighted a strong converse of both categories of corporates who are both investing in ESG KPIs. They also sign up for dynamic discounting platform and implement process automation in order to extract the most value of their organization. In both situations, we see ROI reaching up to 12% of the invested amount. So please, let us dig into 3 specific options to maximize your supply chain investment and liquidity return. So the supply chain financing and dynamic discounting, then we will talk about the process digitalization, and finally about the ESG.
So let's move now to real-life cases. We are starting with Bell, who decided in 2018 to introduce a dynamic discounting platform to the benefit of their suppliers. The objective was very simple: share with their own suppliers cheap funding and offer them a flexible and efficient way to manage their invoices. The client decided to go through different steps. First, start with the French market. Establish an internal working group with the key stakeholders. Second, develop real marketing materials in order to help them communicate both internally and externally to their suppliers. Very interestingly, when they decided to extend it to the rest of Europe, they also faced COVID. And at that point, they took the initiative of offering to their suppliers 0 funding rates in order to further support their key suppliers throughout that difficult situation. That example is a very early case of a dynamic discounting platform in Europe, but also one of the most mature and developed successes that we've seen so far in Europe.
So dynamic discounting. If you are not familiar so far with the concept, it's a marketplace between you and your supplier that allows you to assign or demand an amount whenever you have cash to burn or to borrow. Post-invoice, you can pay early and let your supplier decide whether they want your cash enough to offer you a discount during the entire term of the invoice. Alternatively, you have a short-term liquidity need and you would like to negotiate the payment terms for certain particular invoices. It's feasible. I insist on this during the life of the invoice concept because it's a real game changer. On the platform, you will be able to negotiate discounts or payment term extension whenever it's interesting for you, and your supplier, up till the invoice is due to pay. Obviously, the discount or payment term extension condition will be proportional to the remaining time of the invoice. This is where you always need to come back to the accuracy of your cash forecast. So now let's look at the numbers. One of our retail clients is implementing a supply chain program and a dynamic discounting platform. The preliminary return calculated is 3 times the investment cost. The client will raise 435.5 million at 70 bips and 13.9 million at 50 bips for a 900K yearly recurring cost. Basically, it's 19 bips of funding cost investment.
Let's talk about ESG now. Within finance, there is not one single meeting occurring today without mentioning ESG. We won't make an exception to this rule here today. And so for good reasons. Close to 80% of the carbon footprint of a consumer and retail corporate comes, in average, from its own supply chain. Consequently, if you're committed to a net zero emission KPI, you need to integrate your suppliers into your strategy. Motivating and supporting those stakeholders to move with you in the right direction is not always easy. One solution is to associate them to the reduced funding costs you can extract from your banks and investors. Our experience has shown that most ESG or sustainability-linked fundings today can help you reduce your funding costs by 5 to 10 basis points. To further illustrate your point, we have seen the rise of supplier financing programs where suppliers were not tiered according to their size or strategic importance, but instead based on their ESG ratings. This is a very original and efficient way to speed up the alignment of your suppliers with your own ESG strategy. The supplier financing program set up by Walmart in the US is a great illustration of such type of initiative. Another great example is the ENGIE refinancing announced this week. ENGIE is a leading construction company headquartered in France. ENGIE is active in 17 countries for a total turnover of 2.4 billion euros. We helped our client refinance their RCF for 350 million tenor 6 years and issue a dual tranche EURPP for 150 million maturities 28 and 29. The client referred to 3 specific KPIs. First, the number of women in management. Second, accident frequency rate. And third, greenhouse gas emissions. Stronger objectives for a great company.
So now, what is the ROI when it comes to process digitalization? Implementing an automatically interface P2P, ERP, TMS, and bank process can allow you to reach significant returns. Based on our preliminary analysis, our client can earn up to 110% of their invested amount in direct and indirect savings. So what do we take into account when we calculate these direct or indirect savings? So productivity, of course, financial gains, and also fraud risk. Our fraud risk calculation is based on the numbers communicated by the Association of Financial Professionals, which consider that 57% of corporates are targeted and only 2% of those face successful attempts. So we could consider that on the chart displayed here, the risk decrease is based on a conservative hypothesis.
We sincerely hope this session will have helped you better understand how investing in your supply chain can help you boost your liquidity's ROI, while supporting the very growth of the business. RedBridge is committed to support our clients across their finance and treasury needs, whether they are related to financing or rating, payment and cash management or optimization, technology, process and systems, and cost optimization. Our approach is result-focused, whatever our area of intervention, and defined with our clients from the very beginning of our engagements. Our remuneration is success-led in order to guarantee you our full alignment with your own objectives, raising more than 60 billion euros for our clients across 25 countries and generating more than 375 millions of savings.
I am Iris Rousselier and thank you all for your time. Hope you appreciate it.
I am Alex Leritier and we really look forward to seeing you again very soon.
Merry Christmas.
Thanks a lot for this insightful presentation. The next topic has been addressed in the past. However, it remains a hot topic and a nightmare for treasurers and bankers too. I'm pleased to introduce Pascal Morosini, CEO from iHub Luxembourg, who will present iHub for those who don't know it and what they are proposing now. The solution has significantly evolved as well as the shareholders of iHub. Let's see what could we expect as treasurers to simplify our KYC with banks and to be more easily onboarded by financial institutions. Pascal, the floor is yours.
Hello everyone. My name is Pascal Morosini and I'm the CEO of iHub, the KYC due diligence process outsourcing solution. With these words, I guess you understand our product positioning as a KYC utility for due diligence, hosted, managed, and created in Luxembourg to address the financial center ever-growing workload in managing KYC file efficiently. We ran into production in December 2019, and we are a regulated entity in Luxembourg with a PFS license. Our shareholders are the Post Group and BNP Paribas. Our model is a centralized repository model with a unique selling proposition articulated around a BPO model, a cross-client mutualization ability based on user consent for sharing, an advanced risk scoring module, and an interactive role-based identity software architecture. In terms of facts and figures, we have in our system more than 256,000 natural persons, currently more than 10,000 legal entities, and we have been reviewing more than 70,000 files since we've launched in production. Our team is composed of 85 staff at the moment, and we are actually working on the product since now 4 years. In terms of our product, what we do exactly is that we place ourselves as a third-party validator. That means that each of the data and documents which are flowing to iHub is systematically verified and validated by an experienced team. So the data coming from our clients, from their compliance officers, from their relationship managers, or from their KYC office, which are loaded into the system, are systematically verified by us. It's the same with the data and documents coming directly from their customers, and it's the same from the data that we are collecting from trade registers around Europe to which we have an automated link. All these data flowing to the single file of a natural person or a legal entity, where we can have shared attributes or what we call specific attributes that will never be shared across business relationships. To capture data and document directly from end clients, we have developed an interface that is available on our website or can be integrated into our client's own front end. It allows corporates, but also natural persons, to digitally provide the required information for each of their business relationships so that iHub can do verifications and allow for document mutualization. Moreover, iHub has developed a software architecture that allows us to serve each of our clients on a pure BPO mode, with full confidentiality over their client's relationship and in respect of their own risk-based approach. However, when an end client gives his consent for sharing, the system can share information across business relationships, allowing for centralized sharing, updates, and due diligence review exercise, thus providing the benefits of recent updates to every business relationships. In terms of service features, as I told you, what we offer, our core business is due diligence review. So we're going to be reviewing the files of our clients based on the frequency that they would have told us. We offer risk scoring with advanced attributes. We offer screening on sanctions list, on PEP, or on adverse media. Naturally, we offer the ability to mutualize and share documents and data across business relationships. We do verification as a third-party validator. We offer sophisticated documentation metrics. We have the ability to also manage specific attributes that will never be shared across business relationships. Our system is based on roles, so UBOs, account holders, board members, etc., that could be interlinked between themselves into our system. We offer e-forms as well with electronic signature and naturally notification and alerts that can go to either our clients or the end clients for further action. Ladies and gentlemen, we have built a service to last. Whatever the model, centralized, decentralized, what is important is that we bring efficiencies and increase the quality of the data and checks on KYC file. For sure, digital and technology is the way forward to tackle the KYC CDD workload, but the human expertise of managing complex files and doing analysis remains key in that business. A KYC BPO model helps banks to reduce their cost, but above all, it does provide you, their clients, with a better user experience. Are we here setting a model for Europe? Maybe. Either directly, we will be servicing clients outside of Luxembourg, or indirectly, via local partnership, we believe that we are setting a first model of its kind that will certainly get your attention as we develop. We are looking forward to deliver the improvement you have been waiting for so long. Stay tuned for further announcement in the coming months, and thanks for watching.
Thanks, Pascal, for this explanation and interesting presentation. We are pleased KYCs are funding eventually solutions. Now let's move to the last presentation of the day. It's not really different from the former topic as we talk with Ricardo Balsamo from Delega about the power of signature digitalization. It is also a promising area where corporates faced many problems in the past years. We will see interesting solutions. Let's save this interview with Ricardo. Good afternoon. Welcome to this winter conference of ATEL. I'm pleased to introduce Ricardo Balsamo from Delega. We will discuss today about the bank signatory management. Welcome, Ricardo.
Thank you, Francois. Very happy to be here with you today.
Why signatory management is a pain for corporates, Ricardo?
Well, you see, Francois, from historical reason, signatory management is one of the pain points of the industry that's been, in my opinion, a bit left behind. The market has clearly moved into especially in treasury and cash management space, it's been moving to very interesting solution. People and banks and the whole ecosystem have pushed for, rightfully so, for innovation. You can mention virtual accounts, in-house banks, everything that comes with it. But I think that some of these issues, like signatory management, which are basic, have been a little bit left behind. So I normally used to say that we tried to run and we have maybe forgot to start walking before. And you talk to any corporate treasurer, anyone in treasury, when you come to name what are the main pain points on their side, they will say 99 out of 100 KYC and signatory management, which are actually two processes close to each other, right? So on the corporate side, you have resources that are spent, 1 or 2, depending on the size, FTE, only on pushing paper, which is a non-value added activity in a team like treasury that normally is always short-staffed. And so you see there is a lack of efficiency right there, because this is the area where digitalization should be brought, because people can be moved to more significant value-added activities. There's a lack of transparency on that process. So lots of corporates really struggle to have a clear picture of who is who can sign for what. And the fundamental issue is that corporates and banks insist on 2 different records that they never talk to each other. So some corporates might track those on the classical Access, Excel, and you name it. And banks, they do it on their hand. But you see, you have a process which is unique, managed on 2 different sides. And last but not least, the corporates have to deal with different process from different banks, because typically those corporates are by nature multinational, multi-bank. So they will have to manage probably 40, 50 emails, traffic with 40, 50 banks at the same time, when only one person has to be replaced. And on the other hand, on the banks, you have the same amount of pain and complexity multiplied by the thousands of their clients. So there is also a very high consumption of resources on this side.
Yeah, Ricardo, I fully agree. So it's a bit a paradox, because we have digitalized a lot of function in Treasury, but when you look at KYC, you mentioned, and power of signature, it's not digitalized at all. So it's a bit strange at the age of digitalization to be still with, let's say, archaic processes to upgrade your power of signature. Do you agree?
Absolutely. And we haven't spoken on this equation about the bank side, because you see, signatory management is a process where essentially there's a sender and receiver. So both sides have to be in sync. On the bank side, there is the same amount of pain, same amount of inefficiency, but multiplied by thousands of clients, because every of these, large corporate banks have high number of clients. So there is also a high number of resources consumed there. That means that the customer experience is not ideal, to say the least. In a process which actually is a triple lose proposition, because it needs to be done. There is high consumption of resources, and there has to be precision and execution, because it's a very risky area. So banks are also bearing an operational risk, and I've seen in my career, and I'm sure Francois, you have witnessed the same. Sometimes people leave company and they remain on the books of some of the banks for weeks and weeks and weeks after. And right there, I see also an operational risk, which is hard to quantify, but is right there.
I completely agree. The pain is completely shared by both sides, unfortunately. You worked in a bank, so I really need to ask you, from your side, what would be the right solution?
Well, you see, the ideal solution is a solution where both the sender and the receiver are in sync in an end-to-end process. You see, there's a lot of previous attempts have been done in this space. I personally believe there are different ways to skin a cat, as they say. I think the initial attempt have very much focused on the exchange of messages, which is in principle a good idea, but not necessarily the ideal one, because one aspect is to exchange information over a technical file, if you like, and the other is to manage a process that by nature is a workflow-driven process, so where two parties have to exchange not only data, but documentation. They have to exchange feedback. So definitely a solution where both parties, such as corporates and bank, can interoperate on the same platform, exchanging information, exchanging documentation in an end-to-end workflow-driven process as such. And that's where corporates have been very, very thirsty for new ideas, which I think it's now time to bring on the market, right? Because solution in that space have been tried, but what the market is telling me and what my conversation with the different corporates is telling me every day is that there's still need for the solution for this problem.
Yeah, actually, you need one digital format, standard format that you can send on a similar way, secured to all the banks. That's the idea.
Absolutely. I mean, definitely, bank. You always hear this word bank agnostic, right? So what it clearly a corporate treasurer will tell you is, I do not want to use, if I bank with 10 banks, I don't want to use 10 different platforms. This is what everyone will in corporate treasury will tell you. So there is definitely a need and a demand for, if you like, bank's getaway concept, where a corporate treasury can interact using one single front screen, one single interface that then in the background takes care of the integration and the communication with the banks. You've seen this as well in the payment space with the PSD2 and the API concept, which is pretty much the same idea we're expressing here. I have one access portal. I don't have 10 that I need to deal because it's very counterintuitive to work in one process over 10 different platforms. So definitely the fact that the corporates demand a bank agnostic solution is one of the driver of the initiative that we have started last year.
But why is this time going to be different? We talk about it for years, and here we still are here. So what do you suggest?
Yeah, very fair question. You see, we at Delega this time, we have tried to look at things a little bit differently. Starting exactly from the point you mentioned, why so far we haven't come to a solution to this, and what can we do different this time? So what we have thought is to actually build a working table, a working group where both corporates and banks and fintech work together on the conceptualization of the solution first. Because you see, this is 2020, 2022 actually, right? We're about to send man on Mars. So this is really not a technological issue. It's a process-driven issue. So the most simple thing you can do, if we're not looking at a technological issue, but a consensus issue, is to put the parties in one table and make the end-to-end solution workable for both sides. And that's why we have done this thing simply by just creating a group of people done by banks and corporate treasurer that have discussed how can we do an interaction using one single platform that meets the requirement of the bank and the desire of the corporate at the same time. And where the fintech has played, if you like, the role of the honest broker between the two parties, inserting the technological element, but only as a culmination of a process-driven agreement. So technology has come to last, not because it's not important. It is key to have a robust, secure, and trustable platform. But the main priority was to find consensus by parties. And that's why we have put the process and the consensus first, and only the technology as a culmination of that process.
I do agree. The technology is there, so we just need to make sure that all the stakeholders work together.
Completely. And then one aspect worth, I think, to highlight here is that in the last 5 years, there have been a lot of initiatives. I'm sure, Francois, you have seen many of those. And the general feeling that I gather from most of the Treasury people is, right, another initiative, show me the results. I want to see something concrete now. We've been talking about dreaming solution for a lot of time. There is a little bit of misconception now or deception as a general feeling that a lot of these initiatives have been very, very ambitious, but in terms of practical fruition, there has been really not too much that has come. So one of the driving factors of the working group we have created was to really prioritize speed and concreteness over potentially the deepness of the solution. So you see, there are a lot of things can be done, but the general understanding is that the corporates want it now. So the time of the talk is over. So a little bit just following the 80-20 rules. Let's bring something to market in an agile manner. Maybe it's not going to be perfect on day one, but it's going to be available. It's going to be real. Unlike maybe other initiatives that have been very, very ambitious, but they're still in the very pilot, try and error, let's see whether it works or not.
Completely agree. The time is now.
Time it is now, indeed.
How important is to have a cooperative approach among fintech, corporates, and banks? So
it is absolutely crucial. It is key. Signature management, it is a process where parties need to be in an agreement on how information are exchanged, and it's also an ecosystem-driven problem. There is no value in a solution that works on a bilateral way between one single corporate and one single bank, because those large corporations have by nature multi-bank relationship. So an ecosystem-driven solution is the only way that you can structurally solve this problem. Definitely, you have seen an evolution of the relationship between fintech and banks until something like 4 or 5 years ago. Some of the fintech were perceived as a threat to banks. But I have seen very gladly that there's been a shift in that thoughts. Banks have been very smart in understanding that they can't be good at everything, and they have rather chose to pick up, if you like, the best in class in some of the area and partner up making sure that probably in the non-core activity, which is where they are the best and strong, they're better up to team up with some of the fintech player to create more value for the entire ecosystem. And one of the other things that we have also witnessed in the working group is that banks that have participated in the discussion, they have realized that for this particular problem, there is no value in competition, but rather there's an immense value in collaboration, not only between them, but between the entire ecosystem, so the fintechs and the corporates as well. This is the classical case where 1 + 1 makes actually 3. There is way more value from the entire ecosystem in working together rather than going for single bilateral solution that only solve one aspect of the relationship.
I completely agree. So there is a shift, a clear trend towards more cooperation and what we call co-creations with banks and fintechs. Thanks. Therefore, Ricardo, how to overcome signatory management challenges? What are the main characteristics of the ideal solution?
Well, for sure, clearly the work of the working group and the solution that we put together has been driven by fundamentally 4 aspects. One is the fact that the solution has to be bank agnostic. Definitely, there is the need to work on a solution that is workflow driven and not message exchange driven. Because if you are managing a complex process, you need to work on a workflow driven solution, especially for larger corporation. Obviously, I give it as a given that it has to be secure and fully auditable. So there has to be trust that the information is properly managed and transmitted. And it has to give instant access to the information. One of the complaint and one of the hard to believe but still true fact is that between the moment that a corporate might want to obtain the information and when they really get it, you can have 4, 5, 6 weeks of time before that information is obtained. And sometimes when it's obtained, it's not necessarily always accurate. So amongst all the functionality and the priorities, immediate access to accurate information is a key characteristic. I want to know right now who is who and who can sign what, and I want to know it precisely. I don't want any mistakes because, like we mentioned, you don't want to take any risk that you have somebody on that book that shouldn't be on that book.
I agree. It's important for us because when we send power of signature to the bank, we would like to make sure that immediately it has been translated, transposed into their system. If not, there is a risk of not having up-to-date signatories in place. Okay,
yeah, and
thank
you see, those kind of incidents, they can hurt profoundly as people can be on certain transaction, maybe when they're out of the company. And this should absolutely not be the case. And any CFO would like to avoid that. I'm pretty sure about that.
Ricardo, you are speaking about a simple, intuitive, no time consuming bank account signatory system. Is it actually possible? That's the question.
Yeah, Francois, it is possible. Those almost 1.5 months of joint work of the working group between corporates and bank and has proven a couple of things. That definitely there is now willingness and interest to solve this problem once and for all. So there is this general feeling of, all right, enough is enough. Let's really get this out of the way. COVID has actually been an immense accelerator of that because all of a sudden you have people maybe being in 2 different cities on the corporate side, and a bank that has to send a document to an empty office. So digitalization of interaction between corporates and bank has become a priority since COVID has started. So before it was like, yeah, we should do something about it, but we have other priority. And now COVID has imposed that as a number 1 item on the list. Our upcoming pilots will show that by having all the parties in an agreement, technology can now easily make that agreement possible. And that's why we are looking forward to roll out our pilot in 2022.
What are the next steps and the future strategy or vision? How could we integrate this e-signature and digital identity?
Well, from a next step perspective, we're at the final phases of this initiative. After almost 18 months of finding process consensus, finding a technological translation of those requirements, we will pilot the solution with some key players in the beginning of 2022. So that's from an immediate next step. Now, to the second part of your question, when you talked about integration of e-signature and digital identity, those two aspects are the other two sides of the same coin when it comes to signature management. So the true end-to-end process is made up of identification of the person from an anti-money laundering perspective, so the real signatory, who is who. And then you have the real power itself. So what can this person sign? When the person is set up, then you have the day-to-day work where the financial controller, whoever is in power, will have to transact. So that's where solution like DocuSign, Adobe, or any other player in the market out there will come to use. And we see definitely a vision and a future strategy where within the same platform, the user can jump from one system to the other, delivering an end-to-end process both on the corporates and on the bank. So making what today is probably part of a silos proposition an end-to-end seamless proposition.
Yeah, maybe a comment from my side. So we should encourage our members here in Luxembourg at ATEL, but in other associations in Europe, to support and to endorse your initiative, because it's really important to increase efficiency, as you describe it, and also to reinforce the internal controls and mitigate the risk. Thank you.
Absolutely, Francois. You actually hit the nail on the head. We have discussed and talked about that the only way to solve this is by an ecosystem-driven solution. So I encourage the corporates to come together because it's only by working together as an ecosystem we can really shift the needle here and move the weight where it has to be. So definitely it has to be an initiative where parties come together and not in an isolated fashion.
So I guess it's not the last time we talk about the digitalization of the power of signature. Thanks a lot.
No, we will not. It's a journey. We're glad we started that journey because you have to start from somewhere. It is not an easy equation, but you got to start somewhere if you want to get things done.
Thanks a lot, Ricardo, for your insights and for explaining how corporates could solve power of signature issues. It's now time to close this winter conference. I wanted once again to thank our sponsors, iUp, Arvato BFS, Delega, Redbridge, and Scope for the support and inspiring presentations. Look forward to meeting you in 2022. Before leaving you, let me wish you a Merry Christmas and Happy New Year. All the best to all of you. Cheers.